Hello, welcome to My Crypto Funded's official YouTube channel. This will be the first video from a larger series of educational content that should help you out become a better trader and get as many payouts as possible from MCF. So like and subscribe so that you don't miss out on any future videos. In this first video, we will discuss how to trade ranges. Well, the fact is that 80% of the time price is ranging, as you can see, and only 20% of the time price is trending. And people excel at trading when price is moving in a single direction because you just keep a position open and get as many profits as possible. However, when price is ranging, people struggle to adapt the new conditions, and this is the moment when the most accounts get breached. So in this video, I will explain how to trade ranges so that you don't get stuck without profits when price is not moving in a single direction. The first thing that you need to understand is when price is ranging, so that you can apply the knowledge that I will share with you in the next few minutes. So the easiest way to spot a range is when price creates a key swing low and a key swing high and then never breaks those key levels and continues to trade between them. And ranges can appear on any single time frame. So I can assure that if I go right now on the 5-minute chart, I can see a range, and it's clearly this one where you have a key swing low, a key swing high that for a long time did not get broken. So this is the most important aspect. You need to see two key levels and price keeps ranging between them. Ranges usually occur after price has had big impulse in a single direction. So let's compare trending price action and ranging price action. So for a bullish trend, you will have consistently higher highs and higher lows. For a bearish trend, you will have consistently lower highs and lower lows. However, such a move always ends with a range. So after the last leg up, you will form a range and price will keep trending in between them, between the last swing low and the last swing high. Same with when the price action is in a bearish trend, and then that trend will stop and you will range between the last swing low and the last swing high. For example, on this BTC daily chart, it's clear as day that you had a bullish trend right here, and then the last leg up gave us the range, same as right here. Clear bullish trend, and then the last leg up gave us a clear range. So if you struggle to trade trending conditions, just wait for price to stabilize between the last swing low and last swing high of a trending move, and that's when you can apply the principles of range trading. Now let's talk about how to trade ranges now that we know how to identify them. The biggest trap that I see people fall into is when they see that price goes above a key swing high, the range high, they immediately assume that it's a range breakout and they long with their entire portfolio. That's completely wrong because you more often than not get what's called a range deviation, when price just sweeps range highs and then re-enters the range with a break of structure, so the structure inside the range changes from bullish to bearish, then you retest range highs as resistance, you fail to break out, and then you get a rotation to the other side. So again, remember, the key components of a range deviation are a range high sweep, price comes back inside the range with a break of structure, and then retests range highs as resistance. And the same thing can happen to the other side, where you sweep range lows, you break the structure, you retest range lows, and then you change direction, and then you can target range highs. So this is a short setup where your TP is going to be range lows, and this is a long setup where your TP is going to be range highs. Why are range deviations easy to trade and to spot? Well, because at range lows, you will have liquidity built up from all these lows. So price is incentivized to take that liquidity, sweep these lows, and then turn around. Same with the liquidity at the range highs. You will have lots of people that put their stop loss at this level, so then price wants to go up, take those stop losses, increase its liquidity so that it can move easier to the downside. Now, of course, price has to exit the range at some point. So how does it do it? How do you spot the difference between a range deviation and a range breakout or breakdown, or a failed auction from a successful auction? The key element is to watch how it retests the range bounds, so range highs or range lows. So in this instance right here, this is a successful range breakdown or successful auction to the downside. Why? Because after you sweep range lows, instead of coming back inside the range and breaking the structure and retesting range lows like I explained previously, what you do instead is range lows act as a resistance, and then price creates a new lower low. So while before our key elements were range sweep, range reclaim, break of structure, range highs retested as resistance, now for a bullish breakout our key elements would be a range sweep, no range reclaim, range highs get retested as support, and then you create a new higher high. Same with a range breakdown. After the sweep of the lows, you don't reclaim the range, you actually retest range lows as resistance, and then you create a new lower low. Now there are many possible trading setups that you can use when trading range deviations. The easiest and safest one would be to wait for the break of structure and the retest, and then enter on this retracement with your stop loss at the top of the sweep and target the other side. But you can also target internal liquidity inside the range. We can also enter without a break of structure, but that's a little bit riskier, but gives better risk to reward ratios. You can also enter after the retest of the range highs that thoroughly confirms the range deviation and put your stop loss right here, and again target either the opposite side or internal liquidity. Now when we're talking about successful breakouts or breakdowns, you always want to wait for this retest and a new low, and in that case you will enter a short right here with your stop loss at the high that retested range lows and target liquidity somewhere outside the range. And if you want to take a long after a range low deviation, it's exactly as described, just in reverse. And if you want to trade the range breakout, it's exactly the same, but you wait for the higher high and then you target liquidity outside the range to the upside. Now, range trading should be pretty clear to you in theory, but practice is always harder. So let me actually show you a trade that I took on my personal MyCryptoFunded account last week. So this was the range that price was trading inside. And on New York Open, you got this beautiful range low sweep and the range reclaim. That's our first two steps of range deviation. And because New York Open is so volatile, I didn't actually wait for a retest of range lows, and I entered the trade right here after the range reclaim with my stop loss at range lows and my TPs at range highs. Now this trade went to TP in 2 minutes, and afterwards I actually could have gotten a short as well after the range high deviation, the range reclaim, and the range high retested as resistance, and this delivered price to range lows again. So as you can see, in just under 2 hours you could have gotten two beautiful opportunities to trade this range deviation setups. And now you know how to trade ranges, so make sure you grab one of those evaluations and start trading these setups on MyCryptoFunded. And you can also use code VICTOR for a 10% discount. I hope you enjoyed this first educational video on MyCryptoFunded's YouTube channel, so make sure you like and subscribe so that you don't miss any future videos.